Taxes, taxes, taxes. That's the topic today that I'm going to talk about. It's a topic that I'm really passionate about sharing. Why? Because I really wish I'd learned at least the basics of it during training before I became an attending. So I could slowly build up my tax knowledge to handle the huge income jump from residency to attending. Because as an attending, we pay substantial amount in taxes. So it's not really pleasant to see big chunk of money go out of my paycheck and into the hands of the government, right? But you guys might be thinking, dude, I'm barely making any money. When I last checked, I paid literally nothing in taxes because I make so little during the training. And my net worth is a negative because I'm drowning in student loan debt too. So why should I care about it? I definitely get that sentiment because I've been there a few years ago. So back when I was in training after med school, so I was over $200,000 in student loan debt. Honestly, even homeless people were wealthier than me because my net worth was deep in the six-figure negative territory. So at that point, I had really zero mental bandwidth to learn about anything other than emergency medicine. Because my daily mission was not to get embarrassed while getting pimped by my attendings in front of my peers and everybody during morning rounds and brutal Wednesday conferences. I think I was the weakest link in my residency cohort. So all of my energy went into learning emergency medicine so I don't sound like a, idiot. So trust me, I understand, I get it. Time is limited and your energy is focused elsewhere. That's a good thing. But now I'm in my 10th year of practicing medicine. And what I've learned is this. Once you start making real money, taxes become real big deal too. And soon you're going to notice that a lot of conversation topics that come up in break room, doc box with your colleagues is going to be related to money one way or another, including taxes. In fact, taxes are going to be the single biggest expense of your lifetime. I know many clients and physician colleagues in private practice especially who pay $200,000, $300,000 a year in taxes. Imagine doing that for 30 years. You're going to be handing over 6 to 8 million bucks of your hard-earned money to the government. That's way more than your mortgages, student loan combined. So my mission today is to help you understand how individual taxation work, why understanding is so important, and what tax planning is about, and how tax planning can save you a ton of money over time. Knowing all of this would help you keep more in your pocket and hand less to Uncle Sam. Don't you want that? And none of these were taught in school, and in at least my education system. Nada. I've learned all this on my own. In order to accomplish my mission, I created a story just for you. So let me introduce to you the twins. Dr. Kimbap on the left, Dr. Kimchi on the right. They're Korean. They're twin children, and they're Korean just like my kids. And they're both 30-year residents, and they hustle. They got Korean work ethic, so they hustle and moonlight and make some extra cash. So the one on the right side, Dr. Kimchi, is an organized one. She is not only smart, she's driven, and she serves as a resident, and she's very organized. So if you take a look at her spreadsheet, it's going to be all color-coded, sorted by year and topic, very well put together. But on the left side, Dr. Kimbap is more freestyle, free-spirited, unlike his sister. He's smart, he's ambitious, he worked very hard, but organization planning is not really his strong suit. He does everything last minute. He's trying to figure out where he's supposed to show up, what shift, for moonlighting his residency shift the morning of. When he comes to taxes, he's not interested. He's a true emergency medicine geek. He's really, really into it. That's all he thinks about. So let's take a look at how much Dr. Kimbap made in 2024. He did pretty decent. He pulled in around 70 grand through his residency, which was W-2 income. And being a hustler he is, he moonlighted on the side and brought in extra $15,000 in 1099. He also dabbled in investing, but he went passive, which is good. He owned some S&P 500 index funds, which paid him $500 in dividend throughout the year. And thanks to his always on top sister, he jumped into his real estate syndication deal, which gave him $3,000 of passive income via K1. All in all, he made close to $90,000 total. Not too bad. Let's take a look at Dr. Kimchi's 2024 income. So she made exactly the same amount, $88,500. Just like her brother, same residency salary, same moonlighting income, the same investment income, but on paper look exactly the same. But here's the difference. Dr. Kimchi, she knew that she was going to bring in extra income through moonlighting, so she planned ahead. She learned the relevant tax code, rules to maximize her business deduction, to make sure that she kept all the receipts for her expenses to offset that $15,000 of moonlighting income. When the tax time came around, Dr. Kimbap, he punched in all the numbers on TurboTax. Voila, $7,000 tax bill to IRS. Most people would be upset about it, unhappy at least. But he shrugged, well, what do you want? I made more money, so I should pay more in taxes. He paid and moved on. No stress, no plan. He just wanted to focus on emergency medicine, like a true passionate emergency medicine geek. Nothing wrong with that. Dr. Kimchi was different though. While Dr. Kimbap, her brother, was hit with $7,000 tax bill, she only owed $1,000. Why? Because she didn't wing it. She planned and strategized, and she also executed. She utilized the rules, used the tools, made sure the tax code worked for her. How did she do it is a question. That's exactly what I'm going to talk about throughout this 3-part lecture. I'll break it down how she did it so you can be like Dr. Kimchi, the spicy planner, and not like Dr. Kimbap, which is a true EM geek who's not interested in nothing but learning emergency medicine. So let's get started. So what I've learned throughout the years of learning tax rules is that tax is very, very complicated. There's so much information out there and it's constantly changing. It's just crazy. So if you just try to memorize bits and pieces without really having a good foundation, it becomes really hard to see how those all fit together, because you're going to be distracted by details and some of them will contradict each other. It's crazy. So that's why having a solid foundation is extremely, extremely important. It gives you a good framework to place all those details into the right context. So in order to help build that foundation, I created and coined the term 1040 anatomy. It breaks down the key components that you need to understand in order to fully grasp how individual taxation works. So let's build that foundation step by step. So here's a 1040 anatomy. It's surprisingly simple, right? You see it? There's only 3 major concepts here, and they actually tell a logical story. So you start at the very top, gross income, which transforms into adjusted gross income, and then become taxable income. And taxable income is what really matters when it comes to calculating your tax liability. Once you get this flow from top to bottom, the rest of the picture starts to make a whole lot more sense. So let's start at the very top, gross income. What the heck is gross income? Is an income that is gross? So gross income is basically all the money that fall in your pocket, and that's your gross income. Essentially, you make money, that's income, and income becomes part of your gross income. So your W-2 income, that becomes your gross income. Your side gig income, also gross income. You find $100 bill on the street, that's income, therefore gross income. You win a free iPad in a raffle, believe it or not, the fair market value of that will be income, which also counts as gross income. So let's take a look at money that Dr. Kimchi made to determine her gross income for 2024. So she made the following: W-2 job, $70,000, 1099, $15,000, dividends from mutual funds, $500, real estate syndication, $3,000. Let's try to calculate her gross income. It's pretty easy, right? Everything here is income. Every single thing is income, and it becomes part of her gross income. Add them together, her gross income is $88,500. Why is this important, you may ask? Because gross income is a starting point of every individual tax return. So let's take a look at where this shows up on your tax return, the famous Form 1040. Here it is, page 1. So if you closely, line 1A through A lists all different types of income: wage, interest, dividend, distribution, and more. Each line represents a piece of gross income. When you add them up together, you get line 9, which is your total income, gross income. Here's a great news. Not all income is counted as gross income. There's a concept in tax law called income exclusion. Income exclusion. So if a certain set of rules are met, specific types of incomes are excluded from being counted as gross income. Pretty cool. So essentially, it's tax-free money. You make money, you make income, but no tax on that. So understanding this income exclusion is super important because it allows you to plan to create tax-free income. Because when you understand the rules, the criteria that you have to meet, you can create a right set of facts to meet those income exclusion criteria, and which in turn generates tax-free income. That's what tax planning is about, in part, to create right facts to lower tax. That's my trademark stuff. Create right facts to lower tax. Now then, you might be wondering, where do you find these magical rules? So for individual taxpayer, these rules are found in Internal Revenue Code 101 to 139. So here's simple section. It's a pretty long list. So section 102, as you see it, is on gifts and inheritances. So if you receive gifts and inheritances, those are generally not included in gross income because it's excluded from gross income. Section 117 provides that certain scholarships are excluded from gross income. Section 121 is an amazing tax code that every physician should know. That code section allows you to exclude gains from the sale of your primary home up to $250,000 to $500,000. It's an amazing tax code. So let's do a case study on that. Tax-free home sale under Section 121. To make it fun, let's bring back our favorite twins, Dr. Kimbap and Dr. Kimchi, for this one. So they bought their houses back in 2022 during the crazy COVID craziness, right? At that time, people are bidding, like overbidding, dropping cash offer, no contingency. There's like a house that I represented, a buyer. There's 100 offers on this house. House was not even that good, but regardless, despite the chaos, these guys both managed to buy houses in the same neighborhood, same street. And the year later, 2023, after seeing how much his house appreciated in value in just 1 year, Dr. Kimbap decided to sell and cash out. So he sold his house after owning for just 1 year, walked away with a cool $250,000 of gain. That's way more than his residency salary, right? Not bad. Dr. Kimchi also noticed that her house on the same street as her brother also appreciated substantially. But she didn't sell in 23. She held it 1 more year until 2024. Why? That was all part of her plan, because she knew that Section 121 inside out, the home sale gain exclusion rule. So when the tax time came, Dr. Kimbap realized that he screwed up. He messed up. He found out that he was getting hit with $60,000 in capital gains tax bill. Meanwhile, Dr. Kimchi, entire $250 gain was tax-free. How? It's unfair. Well, life is unfair. So Dr. Kimchi knew the tax code, especially Section 121 inside and out. The code says if you're single and both own and live in a property as your primary home for the last 2 out of 5 years before the sale, then you can exclude up to $250,000 of the gain from your gross income. Tax-free income, baby! So knowing that, she waited on purpose 2 full years to meet those requirements before selling. Dr. Kimbap, on the other hand, didn't qualify because he only owned and lived in it for 1 year, not 2. That's why he ended up paying $60,000 in capital gains tax. Just knowing this one piece of code, tax code, was worth 60 grand. Right? There's no secret here. There's no secret loophole. We are not talking about offshore trusts or anything like that. This code section has been around for the past 30 years, available for everyone to use. Nothing new. But Dr. Kimchi knew the exclusion, but Dr. Kimbap, who wasn't really interested in anything else but emergency medicine, didn't. Well, there's nothing wrong with that, right? I was like Dr. Kimbap. So this is a powerful example that having tax knowledge can translate into real money in your pocket. So let's do a quick recap on gross income and wrap up part of this talk. So gross income is sum of all income unless an exception like Section 121 applies. And understanding those exceptions that lower your gross income is a big part of tax planning. And gross income is starting point of every individual tax return. Hope this was helpful. Thanks for tuning in. I'll see you guys in part 2.